rank as a country, as a nation at number 3 in terms of PPP in the growth. We are the fastest growing economy, and if we look at 3 other economies, US and Europe and Japan, which perhaps they are fighting more on the deflation side of it. If we want to see how deepened the banking sector is, one of the benchmark is used is debt to GDP. If we look at that, just one single benchmark to begin with, I'm sure my colleagues here on the dais would come out with different benchmarks. India is, I think, about at 75% debt to GDP. And if we compare it with China and UK, they are at about 170%. If we look at, I think, United States of America, it's 235%. Japan is much more. But they are at the different stage of evolution of their economies. So I don't know how far this holds good. First, I would invite Mr. Sriram to put across his views on this theme, which for this session is how to reach global size and efficiency with a specific reference to, I know, with the kind of experiences both you gentlemen have, if the size really matters, or if it's the efficiency which should be given priority over the size. Mr. Sriram.
Thank you, Mr. Arun Tiwari, and Mr. Tiwari, CMD Union Bank. Thank you for the nice introduction. Unless you hear this time and again, you don't know how old you've become. So in a way, it is time to remind yourself that you have experience, but you're also getting older. Anyway, Mr. Abhishek Diwanji from ENY, he's no stranger to any of our banks, and I think he's been helping us more on the risk side in many ways than we can imagine. Distinguished guests who have assembled here, fellow bankers, press, and ladies and gentlemen. The topic here is how to build a global bank, a global size bank, and what are the efficiencies involved in that, whether it is worthwhile building one or whether it is better to go ahead with what you have. And I will try to relate it in, to discuss this in a few points in terms of trying to see as to where we are headed, where we are today, where we are headed, and how should we look at it, whether it's a good thing or some thoughts that I thought I'll point out and put some thoughts in your minds. You see, for the last so many years, global banking has been dominated by 11, and this is something that these are facts. Some of the things that I'm going to read out is more or less facts, but it puts some perspective into the topic that we have. Global banking, as for the last few years, many decades, has been dominated by about 11 behemoths. And if you see over the period of last maybe 2 decades, up to 2008, there had been a significant increase in their aggregate assets. If you see these 11 behemoths together, up to 2008, they had total aggregate assets of about $22 trillion. And since then, from 2008 to current 2015, the aggregate assets of these 11 behemoths has come down from 22 trillion to 20 trillion. So that is one fact that I think I'd like you to keep in mind. We'll discuss that later. The second thing is that if you remove the 11, and go into a larger group of 30, what we call global SIPs, systematically important institutions, if you go to those 30, actually there has been a growth between 2008 and 2015. There is a substantial growth there. If you go back 25 years in 1990, only 3 of the 100 biggest lenders of the world were from Asia. Of the 100, in top 3 out of 100 were out of Asia. And today, of course, you are all aware that the top 4 are Chinese. And the 5th one, actually, which is HSBC, does most of its business from Hong Kong. And so you have actually 5 out of the top 10. And there we had 3 out of the top 25 in the top, 3 of the top 100. This is the second point which I thought I'll point out. Asia growing vis-a-vis the world. Third is, of course, that if you see in the 10 biggest in 1990, the same year, contributed only 16% of the total world GDP. In 2008, this figure of these 10 biggest banks, they started to contribute almost 40% of the world's GDP. And today, in 2008, actually the top 10, as I said, you know, the 22 trillion has become 20 trillion. The top 10's contribution in the world GDP has actually come down from 40 to 35%. In contrast, if you have the Indian banks are barely 1% of the total global banking assets. And we are just about 5 to 6% of China's banking assets, and we are compared very often with the Chinese story. If you look at the top 5, you know, these are perspectives in terms of global. I think Mr. Tiwari had said about 75% of the debt to GDP is India's thing, and still there is a substantial growth for improvement. But if you see loan to GDP is even worse, you know, it's only about 53%. And our reach in terms of number of accounts that we have opened in terms of population is just about 35% of the total Indian population have bank accounts. So the reach as well as the scope for further improvement of banks' loans is significant. The other thing which I thought, you know, as a part of a data point I'd like to leave with you is that the top 5 banks in India contribute less than 40% of the total bank book, you know, of the total assets of the bank. The top 5 account for only less than 40. But if you see in certain countries, you know, all the different countries, whether it is in Asia or in or abroad, in Australia it is 90%, top 5. In Brazil it is 74%. Canada it is 84%. China it is 68%. UK it is 77%. Japan 58%. Even Indonesia 59%. Malaysia 68%. And even the US it is about 50%. So actually we are in a position, you know, where today there is a much fragmented banking structure in India, in the sense that the top 5 don't account for 65, 70, 80%. Top 5 actually accounts for 38, 39% of the total banking assets. And if you see size-wise in terms of top 5, the largest, of course, SBI, in excess of $400 billion. But if you see the top bank in the Chinese bank, ICBC, it's 3,000 billion. You know, we are almost 1/6 of that. And if you see the next biggest bank in India, it's about 1/3 of India's size, of SBI's size. So that is where is the scope there, as I thought, you know, I will lay out as a perspective for this audience. One, are we, when we are building a global bank, are we looking at reaching the size of Chinese banks? Or are we looking at consolidation in the banking sector here and making sure that as the economy and as the growth happens in the Indian context, there are more number of banks in the top tier who would be able to fill the gap of creating a structure which will account for about 60 to 70 or maybe 75% of the total global assets, of the Indian assets. I did talk about the lower reach and the lower penetration, the lower loan to GDP as well. But there are a few things which are there which probably which we'll need to keep in mind. One is that there is very little differentiation between the banks. If you see the structure in terms of, when you talk about most of us as total full banking license, is basically what we are talking of as a universal bank. Now, whether that universal bank exists or not in whatever form is something that is debatable. Again, it's another story. But today, all of us do everything. We do corporates, we do retail, we do investment banking, we do to some investment banking as part of, not within the bank, but as part of some of our subsidiaries. And also we do treasury and other advances. The model is the same. There is very little differentiation between the models of different banks. Is it a worthwhile model going forward? And if you see the structure of the models, it could be in terms of two structures. The larger banks have 55-45, the other banks have 52-48, and that's about it. So is it a worthwhile model that each one takes a piece of whatever is left and goes forward, or is there a need for a differentiated model as well? One of the thoughts that comes very clearly in this in the model in which and I will talk about about efficiencies later. But in terms of what the lessons that have been learned since 2008, in terms of the risks that are there, in terms of the current problems that the Indian banks are undergoing, it's a system risk, because as I said, the model is the same, and all the banks have followed more or less the same model except for the retail banks. Also, from the lessons learned, is it a good thought, and that is some thought that I'll leave with you, is to differentiate or merge. This is something that probably we can discuss in terms of whether we go with a differentiated model or we try and consolidate some of the banks which have the same model so that you get the benefits of scale, advantages of scale. So in that context, if you see, there could be, and it goes right back to the Rangarajan committee days where, I think, we are reinventing the wheel, where you have these global banks, you have the national players, and then you have the niche players. Today's challenger banks, today we have another 23 banks who on the horizon were trying to come. At one point, I guess the question will be that you're talking about some consolidation in the banks, but are you also looking at 23 new players and maybe more in the offing, as payment banks and small banks, and the two of them, of course, are full license banks. Now, what do they stand? Where do they go? Those are things which are there, but obviously, the model has to be differentiated. The model has to make sure that they don't fall in the same rut. One of the, I wouldn't say problem, one of the concerns that we have is that once you have a problem with a certain model, like for example, today we have a certain issue with the concern with the corporate book, everyone tends to go towards retail. So in that context or in that sense, will it be possible to ever talk about sizing up, scaling up, and making global banks here? Because if you see worldwide, if you see the story of China or Germany or even the US, what had happened was as the economy grew, and as the economy grew, there were certain banks, as I said, most of them landed up in the top 4 or 5 banks, which grew along with these economies in the same scale, and purely not on retail. They were the backbone of the corporate world, they were backbone of the investment world. M&As happened across the industries, and that is why these banks levered in size as we went into the growth path of these economies. Today, India is on the threshold of, you see, the RBI governor yesterday has talked about being a bank which is a silver lining, in a different example, but still, it's a silver lining, which is there. Huge investments are coming in. There are huge policy pronouncements which are taking forward not only the manufacturing story, but also investments in defense, in railways, in smart cities. For example, the other day, when we are talking about 20 smart cities, the investment that is required for 20 smart cities is actually $8.3 billion. Now, where is that money going to come from? Partly, of course, a significant part may come from the government and state governments. Some part of it may come from multilateral agencies, but a large part of it in terms of funding has to come from national lenders. The national lenders, when you start to look around, there are very little. There are not many banks of size. And if everything comes to the doorstep of one bank or one institution, I think it's not a good sign. So where we are getting ready for a significant increase, where we are trying to grow even at the worst years, we are trying to grow at about 7%, and 7.5% is probably a written. And if the monsoon is favorable, I think we should be growing in excess of 7.7, 7.75 this year. These are factors that will, leapfrog most of the other economies. And are we in a position that some of the banks are, in terms of size and scale, in a position to support that growth in a significant way? Some of the thoughts in terms of what are the prerequisites actually for scaling up and sizing. That is something that we always think of. Obviously, there is this big issue of capital. Now, how does it? Where does the capital come from? Typically, there are 4 or 5 sources. One is, of course, the the internal accruals. If the banks are efficient enough, they will generate enough resources and plow it back. And to my mind, in case, if you do an internal study of any bank, if they have to grow in excess of 15% loan growth, the ROE and ROA should be around the 20 and 2% mark, and we are far, far lower than that at the moment. So if that doesn't come, then where will the money come from? This is, of course, you can go to the market. Valuations are depressed in some way. How do you improve valuations? Again, by improving efficiencies. That is the second part. Third is, of course, that you have, the stakeholder. Most of our banks are in the state-driven thing. The stakeholder coming in, which is probably the Chinese model, in terms of the state putting in more money, plowing back savings into the banks, and making the banks lend the sizable assets of the economy. So that is something that is there, but that is, of course, has limitations of how much the state will be doing it. But all these, they'll fall in place if we can make substantial improvement in our costs. And efficiencies actually has to be driven in the cost model. Today, if you see all these big banks are, when they are short on business, all of them, whether they're, the American banks or anywhere else, all of them are looking at costs. And costs are threefold. One is which are the geographies which give them better margins. And we can withdraw from certain geographies where, where the risks are high and the returns are minimal. Second is internally, how do you size up? How do you make sure that all the staff functions, if it is risk or compliance or IT or staff or whatever it is, how does it all add up to make sure that the overall costs come down in a significant way? And of course, the third is, of course, try to make sure that the resources that you mobilize, whether it is in the center abroad or in the domestic center where you operate, a significant part of your resources has to be mobilized in a way in which they are more efficient. All this will make sure that your costs are much, much more in tune with what your efficiency levels are. And unless you take care of that aspect in a significant way, there is very little that you can drive in terms of getting the ROA and ROE upwards of whatever figures that I had quoted earlier. The competition is extreme. In terms of the early, what we used to have, low-hanging fruits in terms of certain fee income that we used to have, competition is definitely going to drive down all the charges in a significant way. There will be pressures on margins because of the fee income. It's only the better, the more efficient, and the more people with more products will start to gain much more traction in that. And thereby, I guess, the advantage of a bigger bank could probably be there. The second issue is, one is, of course, the capital. The second is, of course, the HR issue. A significant part of the HR, especially in public sector banks, at the top level, at the talent management level, will need to be recouped, replaced as we go forward. The third, of course, is the IT area in terms of robustness, in terms of reliability, in terms of scalability. I think these are all very important areas. As you go, and some of these products that today we are not giving, and today we are not, like for example, some of these derivative products, commodity hedging, for example, these are all things of the future. They will surely come one day or the other, and they need to be done, because in the way the commodity prices are today going on, it's going to be very difficult to continue to have the corporates hedge commodities rather than the banks providing them a window. So these are issues that are there, and some of the other products that we surely need in banks is something like CRM, something like workflow management, which will help not only in terms of growing business in the direction in which you want, but also significantly reduce costs in a different way. One of the challenges in becoming a scalable global bank is the nature of your international operations. It's a very high risk today in terms of the regulatory requirements that are there. It's becoming very, very challenging to satisfy all regulators. You would have seen the flow in terms of KYC, AML issues that we have across the globe with the world opening up. And more than anything else, we need, when we go abroad in terms of expansion, we also need low-cost local resource. And that is a very difficult, because local resource is very important today. because of the LCR requirements of the regulators that are there. So if you don't have local high liquid assets in the country in which you operate, it becomes a problem in terms of maintaining LCR, and thereby the cost goes up significantly. Now, where do you get the low cost reserve when you still, you're limited, your rating is limited by the the country rating. And to that extent, the costs are built up. So the question of getting risk and sizing up, scaling up the international operations is another issue. And finally, of course, in terms of the prerequisites, some of the requisites that we need to develop as a global bank is the investment banking capabilities within the bank to some significant extent in terms of looking at structures, looking at carefully the risks associated with certain structures in terms of what the companies are today doing, and making sure the risk to the bank is mitigated in a significant way. So M&As, risk management, I think these are things, structures, these are things that the investment banking arm within the bank should be able to guide us and make sure that we are able to do. And largely, of course, the area of Forex, which is a significant impact today, because Forex, even in simple, we used to do a very simple hedging in earlier days, and make sure that a transaction is done from X to Y. But today, even the rupee, what we call the rupee transactions outside of India is becoming threateningly difficult to look at. And the way the exchange risk is today needs to be managed and mitigated is a significant portfolio of any bank, more so as we grow in size. Until the 2008 crisis, it was very fairly assumed that combining all types of finance or all types of models into one institution will surely drive down costs and improve efficiency. That is why everybody said to put everything there, get the cross-selling through. So if you do a corporate finance, make sure that the CMP is there, make sure that all the other products of insurance, general insurance, asset insurance, life insurance, personal accounts, salary accounts, everything is there, and thereby you will be able to get business. You can get Forex business, you can get merchant banking business, and so on and so forth. So these are all improve efficiencies, make sure that the costs will come down. So thereby the growth in, as I said, in balance sheet sizes of all these banks significantly grew till about 2008. But if you see in Q3 last year, the average ROE of banks of over $1 trillion of assets, this is the large size banks, $1 trillion above of assets, was 7.9%, average ROE for them. And if you see the pre-2008, you will probably remember that they were ROEs of more than 15%, 15 to 20%. So significantly reduced. Why? Because of the risks which are there, and the requirement to manage risks, even in terms of trying to put down costs for compliance, is a significant risk. And out of that, these banks of 1 trillion and above, if you remove the Chinese banks, the ROE actually falls down to 5.7%. So the spreads are narrowing across the world. The banks, who are in the developed countries are finding it difficult to justify an ROE of 5.7%, they don't justify a great deal. And you also see, because of this, that a large number of banks are actually withdrawing from certain geographies, pulling out to reduce the costs and reduce the risks involved. So to my mind, actually, there is this two broad points which I would like to put before you. One is, of course, the fact that middling is always beautiful, is that you don't grow too large in size to become, then you start to de-size in some way or the other. So middling will always be beautiful. And if you see the middle-sized banks of up to 1 trillion, between 100 billion and 1 trillion, they're actually doing much better. Other than the other banks who are niche banks, who are doing payment banks or some other retail banks and so on and so forth. So average size, asset size of between 100 billion to 1 trillion, we should have, we should try and build those assets, those sort of banks. Clearly, the ROE in these banks are 3 to 4% higher than most other banks which are there. And so to that extent, I think there is also a margin which is coming out of this issue. The second is, of course, that is one point that I would like to make in sort of conclusion. The second point, major point, is that I think we need at least 4 to 5 banks of similar size. As I said, who will have at least about 65–70% of the total banking assets in the country. So you will have challenges there, you will have competition, you will make sure that there is enough talent in the banking system to go ahead with the sort of the government initiatives and growth story. And these are the 2 broad points that I make. But as a last point, I think there is also a prerequisite in terms of, there are certain 2 things, major things. One is that our financial markets must be much more deeper and broader. Banking system alone cannot solve all the requirements. It should require a financial market of size and stature. Corporate bond market is actually not developed at all. And there are various issues with that. But I think that is very important for us to not only drive retail and corporates into the corporate bond market, but also in a significant way to grow it in some way or the other. And the second more important point is in terms of resolution and in terms of legal aspects, that there has to be a significant improvement in that. Some of the steps that the government is taking in efficiencies of DRTs and the bankruptcy court, I think they will surely be a prerequisite for banks to continuously go in the direction of making some of the banks as global size banks. Thank you.
I think Mr. Shriram gave a 360-degree view of what is required to be done, starting from where do we stand as an Indian banks, covering just 1% of global banking book or 5% of that of China. Top 5 banks, just about 40%, whereas if we compare with other geographies, the many examples he gave, much lesser. And perhaps there is a need to reach out. It's more about the uses. It's more about to look at, are we just the clones, or we should walk beyond that. If we look at the licensing policy of Reserve Bank of India, the kind of licenses they have given in the recent past, they are different kind of licenses, three types of licenses. So that makes it all the more incumbent upon us. But Mr. Shriram, being a public sector bank employee, do we have the choice? You have to fund infra and you have to fund mudra. And you have to do the retail lending also. And you have to do Jan Dhan also. So to the extent we have the choices, perhaps we are making the best options available to the field functionaries to do whatever they want to do. And very rightly you have said, efficiency, ultimately it's all pervasive. It's got to be starting from your HR, the efficient IT and efficient tools of risk management. And if we look at that, perhaps what we are converging on, and I think, Abhizar, when you speak up, if there has to be growth, it has got to be efficiency-led. Otherwise, it may not work. Thank you so much. I'll invite Abhizar to put across his point of view. Thank you.
Thank you, Mr. Tiwari, and thank you, Mr. Shriram, for your wealth of experience that we just got. Frankly, just at the onset, the topic seems to be that how do we size up to global levels? Question number one, do we size up to global levels? I think if we size up to a recent national level, we are good enough. Because global comparisons at best should only be in terms of size and efficiency, I would agree. But really in terms of the size of the banks itself, I think if we are able to achieve a size where we can fund a large project all by ourselves, that is a decent size I would go for. So frankly, and the biggest risk is this, for example, Icelandic banks. Their total assets grew to 110 billion euro, when the GDP of the country was 15 billion euro. We don't want that situation. We have been through that phase, we have funded overseas acquisitions, we have done a lot. But I think if we just stick to how do we fund our national products, there is much more than that available within our system. Also, we are talking here about growing to size at a time when we are dealing with a large NPA problem, at a time when the economies have, Indian economy as well as the global economy has slowed down, at a time when we are going to have 23 new banks coming into the fray, at a time when some of our banks desperately need capital, but there is no capital in the government to provide, we are talking about growth. But the positive part is, I think there is growth. For the simple reason that we have an economy which grows at 7%. None of the other economies can boast of that. And if an economy generally grows at 7%, if you apply a particular capital output ratio, banks have to grow at 20%. There is no other way banks cannot grow at 20%. So there is clearly growth. Now, frankly, where does that growth sometimes come from? Few things that I had, and I want to touch upon 2-3 things. I will aim not to repeat whatever Mr. Sriram has already said, because there is no point. So I would just like to deal with a few things. One of them is consolidation. I would like to deal with consolidation, but in a very different context, not in the context of saying how do we merge banks. Second aspect on technology, as Mr. Sriram again referred to, I would like to specifically talk about digital and analytics. As how these two things are going to impact, because don't forget, the 11 banks that are coming in now, the payment banks, are predicated only on digital and analytics. And they will have the ability to sweep your market. The other important thing, of course, I want to touch upon is bad loans, which is a topic very close to my heart. And the last is about India's own initiatives. What are we doing? So frankly, when we come into consolidation, consolidation obviously has, textbook will tell you many benefits. It of course has cost benefits. A simple statistic is that if a bank grows by 10%, cost saving is 20%. So its cost saving is almost double that of the growth. So obviously, as you grow in size, you will save more costs. Talent acquisition becomes much more easier, because people would want to join more sustainable, large, more diversified banks. Third part is also itself is risk diversification. What you end up doing, while Mr. Sriram alluded to the fact that do we have many businesses in the thing, I would look at it that if you have more risk diversification, your stability increases. If you put all your pots in one basket, sometimes it may not work. So it is also important, and the right balance in terms of diversification as well as risk management. So we think that is extremely important. The biggest thing is when we talk about specialization, I will touch upon specialization a little bit before I come into consolidation. When you talk about specialization, should a bank be specializing in a few things? And the market will evolve that way. The fundamental thing that is required, and this group should actually represent, and IMC maybe should actively represent, is that there needs to be a very good transmission of funds. There will be people who will be very good deposit takers. There will be people who will be able to raise bonds in a bond market, long-term bonds, for example, and they will then develop the expertise to lend to infrastructure. So there will be a lending expertise somewhere else, there will be a deposit-taking expertise somewhere else, there will be a pot of capital somewhere else. Take PF, take every other form. All this has to transmit well, because unless there is an efficient transmission, the ability to provide capital will not go. The ability for every bank to run after deposits will not go, because today deposit is the single largest competitive advantage that people have. That is the reason why banks are formed. But if you look at anywhere else, is deposit the most important source of deposit, source of funds? Not really. There are bond markets, and we have to work towards building a bond market. Now, sometimes one asks the question that who wants the bond market? I'll be a little open about it. We have a banking system which generally lends at AA pricing. We have a government system which generally borrows at 7.5%. Without any real measurement or market mechanism. If these are the two biggest constituents of your bond market, why does anybody need a bond market? Why does, for example, India's AAA, so-called AAA, want ever the market to price his bond? Because the minute the market prices his bond, the bank will start pricing his loan. Today, the loan is available conveniently at AA pricing. Whatever his actual rating is, one doesn't know. So it's very important that we bring about that transparency. We will take the little bit of pain up front. But I think there is a larger benefit going forward. Now, of course, we are taking too much pain right now. So whether we should do it right now or we should phase it out, I guess is a question that has to be answered. My opinion is that we are trying to do too many things at the same time, too many good things at the same time. Not all of them necessarily complementing each other. So we want to retain a budget deficit, yet we want to finance our banks, yet we want to clean up the balance sheets, yet we want to provide for all the loans. It is going to be a difficult mechanism. I think, but we'll have to go through that pain over a period of time. But we should go through it. So that, in my view, is consolidation. First of all, consolidation of our own balance sheets. Taking the right decisions and saying, if I have to take a hit, I will take the hit. But I will move on after consolidating. And what I mean by hit is not necessarily a loss to the bank. But what I mean by hit is to say, I will make sure that I have maximized my recovery. And maximization of recovery actually means re-looking at that same business you've lent to, figuring out what you can actually recover, and focusing on return on capital. So return on capital may say, let me settle with somebody else and sell off the asset, it's not my business to run this asset. The return on asset may say, let me provide him additional funds because I believe in the long term that business can revive. The return on capital decision would also say that let me write it off and move on because I'm spending too much time on it. So in my opinion, to first consolidation is within our own balance sheets. The second consolidation, and I do appreciate that legal entity consolidation has its own challenges. So let's talk about process consolidation. So for example, JP Morgan and HSBC did this around 10 years back. They have a common AML back-end process. So HSBC and JP Morgan actually share AML at a common platform. The KYC AML is done once for both the banks. Why is that not a proposition for our government sector banks? Why should there not be one AML engine which all banks set up? Standard documentation comes in. Why should every bank do its own AML and KYC every time? And they can plug into it. It's a managed service. I think that is the first level of consolidation. It will save cost. The second is technology. I briefly talked about, I wanted to talk about analytics and digital. So analytics and digital actually is the future of banking. And I think there's a consolidation angle to that also. If you look at analytical and digital, frankly, what is required? Take all your past data, clean it, and come out with reports either for management, as in for management MIS, or for customer-related behavior. Frankly, imagine the power of somebody who actually says that I will take the PSU bank's data, put it into a center, put the relevance independence wrap around it so that one data does not get manipulated with the other data, and people get right data in an anonymous form. So you should not know which bank's data it is, but you should get the benefit of that average analysis. If you had a back end, rather than every bank building up their own analytics and digital platform, at least analytics platform, if that analytics platform was something which was moved to the back end and managed centrally with an independent body running it, I think there is tremendous saving in that. Today, the technology spent at banks is huge, 25%. Cut it. Let all of them cumulatively spend together, maybe the spend will come down to 10%. There has to be the right tone of faith. We have common ownership, so there is obviously an advantage in doing that. If we actually use the common ownership till it lasts and put the back end, I think there is a lot more to gain from actually having a technology consolidation. Digital analytics, again, I will just take this opportunity to say that will actually lead to revolutionization in banking. You have these payment banks coming up. The predicament of every payment bank is that they are going to own the customer. And what do you mean by owning the customer? You will own the customer's data. You will know how he behaves, you know what he wants to buy, you know what you can sell to him. And if they start owning the customer, then a bank will simply become a warehousing of either deposit or loans. Because you don't own the customer. It will be that Paytm, for example, which will source a loan and will choose to give it to any bank which is the cheapest. Because the bank is just a warehouse. He doesn't own the customer. It is that payment bank which is going to own the customer. And why he owns the customer? Because he owns the analytics around the customer. If the banks decide to build their own analytics, that will be a better defense form that they can do because they already have a deposit base. They already have the loyalties. People want to bank with them. But if the service offering is differentiated, then they may end up gaining. So I frankly think that there is enough and more to gain actually in terms of analytics, and one can do a lot more in terms of getting analytics efficiencies. Third, of course, is specialization. Assuming we achieve some level of transmission, frankly, there has to be specialization. And what do I mean by specialization? People will have to have deep sector knowledges. So for example, we have had Indian banks fund Indian infrastructure. For example, our credit has gone at 1.4 times GDP over the years. It's tapered down a bit now, but earlier it was 1.4. I mean, the average is 1.4 times GDP, which is very good. We should lend to infrastructure. We are the lending institutions of the country. But we have not lent it, maybe in hindsight, with the adequate knowledge of what it is. So infrastructure lending, for example, is not lending to an asset. It is lending to a bunch of rights. You are getting a right to build a road and run it for X number of years. You are entering into a right to provide power to a particular power entity. So infrastructure is nothing but a bunch of rights. Now one has to understand the differentiation between asset-backed lending and a bunch of rights. I'm not saying we don't understand it, but if people were to specialize it and have industry knowledge, there will be a parity of knowledge between the banker and the promoter. That is when governance will come automatically. The governance cannot be built by somebody putting in processes, somebody coming and auditing it, frankly. It comes from building that as a culture within the system. And the culture will come when you have parity of knowledge. So specialization, in my view, is parity of knowledge. And some will become retail banks, focusing on retail, some will focus on infrastructure, some others will focus on SME type lendings. That will happen. But for all of them, I go back to my word, transmission of funds is extremely important. Funds have to be fungible. They should be moving. There should be a bond market where you can borrow and lend funds easily so that the provider of loans can actually get the capital from the market. That as and when it happens. Frankly, the other thing is big opportunity around India's growth is around India initiatives. We frankly think Make in India is a massive opportunity. And if you look at it, if you're inviting foreign large corporations to come and build in India, they are attracted by a 7% growth, they'd like to come and build. We are lending on their credit risk effectively. And that is a big, big opportunity for us to lend well. Because it opens up an avenue just from, apart from Indian promoters and Indian entrepreneurs, we are able to lend to others who are setting up in India, creating employment, creating assets. So frankly, our ability to say that, can we lend to this particular sector? I think it's a massive, massive opportunity for India to lend in there. HR, frankly, I would agree with Mr. Sriram. I think HR is something which has been built over years. But what I actually believe is, if you interact with people, and I've interacted with a lot of these bankers, I frankly find that the skill levels are there. The knowledge levels are there. The enterprise and the drive is there. I think the environment needs to improve better. And I'll be a little open about it. Frankly, we need to trust the bankers much more. The bankers, again, need to trust the promoters much more after doing enough due diligence. But unless there is an environment of trust to say that these are companies which can either be revived or are eligible for funding, we will never cross that barrier. Today, there is only skepticism. And even a Chartered Accountant Institute tells us that we have to go beyond skepticism to something called healthy skepticism. And once we have healthy skepticism, I think we have the ability to lend people. We have the ability to understand projects much better and do it. So this is frankly what I have to say around consolidation or India or HR related issues. I'd just like to end my note on a very chartered accountant type thing. You know, there are assets and there are liabilities. But banks are the only place where frankly assets have turned into liabilities now, and liabilities in future through analytics and digital will turn into assets. Thank you.
Thank you, Abhizar. But as what Abhizar said, a typical ENY kind of a firm's perspective, all encompassing. First thing was the transmission of funds. If that is efficient from your liabilities to asset side, how efficient we do it, how processes are efficient, how products are efficient, that would make the difference. And then another dimension, consolidation of the own balance sheet, wherein perhaps what you meant was cleaning up. Whatever is, face it. I mean, not that what that old adage is, dare to ride the bull or take the bull by horns, dare to ride the panther, but we should know when to get off the panther also at the same time. And doing all the things at the same time would be a little difficult for the banking industry as of today, that you do just about everything in one go, and that time frame may be a slightly difficult task. Transparency and governance, I think that should be the hallmarks. For sure, analytics, yes, it's a big tool in our bank. We have been using it for last 12 months, and it has done fairly good results. And specialization, of course. So what I get the feeling from both of these eminent speakers is, size really doesn't matter. It's more about the efficiency. If we are looking at our economy, the way we are moving, it's about efficiency more as of today than the size. Because we have seen globally big financial institutions who had the size, who had perhaps efficiency, who were well rated, because one of the questions asked what about the rating some time back, and who were well capitalized, still they failed.
No, my take would be slightly different in the sense that, as I said in my remarks as well, uh, size is surely important when you're growing into an universal bank. You know, it's not that if you're a niche bank, a bank with a certain segment group, then okay, then you know you can look at being a player in that market. But as you grow in scale, and especially related to the scale in which the country is growing, you know, the backdrop is the country's economy. And on that, if you don't have banks of scale to support that, and I did mention that, you know, if you see in Germany, it is Deutsche Bank, in the US, it is Citi and JP Morgan. In China, of course, it's a different model altogether, but there are 4 banks who are strongly behind the state. In some ways, you know, and you did mention that there are state-related demands on certain banks, but yes, in addition to that, there is a very clear requirement for us, you know, if you are going to drive defense, railways, smart cities, and so on, and manufacturing in a big way, unless you have size, you know, and I said, you know, I did comment that middling is beautiful in the sense that you can't go out of shape in a different way, but if you have top 5 banks aggregating about 70% of the loan book. And if you see, most of the loan book in India is about 50%, 50 in retail, 50 in corporate. And if corporate doesn't grow, and if you get only valuations from the retail side, I think it's a very unfortunate thing. And in some way, we need to factor in size in a way in which we grow the size along with the environment in which you are operating. And obviously, the efficiency parameters, without efficiency, there's no meaning in having a bank as well. So if you're not looking at targets of great ROEs and ROAs and plowing back a lot of profits into the business, I don't think you should be in the banking business as well. So efficiency is a given. Without efficiency, you can't survive. Size for some should be there. Otherwise, you know, if you're limited by saying that, look, size, it doesn't matter, I don't think we have much future for the country, actually.
I'll ask the same question to you, but with a slight rider. Size on both sides of the balance sheet. Would you care for the size on the asset size or the risk-weight assets, A? And on the resources side, it's cost of fund or cost of funding, or just the size on the liability side?
No, so frankly, the risk-weighted assets obviously is the measure on the asset side. Because if you just build a book only around government securities, then that's hardly size. Similarly, on the deposit side, it's important that the cost of funds is lower, because if you again pump it up with just term deposits, it's not going to work. So of course, clearly it has to be the quality of the size, if that's what you're asking. But more, I would agree with Mr. Sriram again, that size is important because size actually gives you many benefits. As we said earlier, it gives you a cost benefit almost immediately if you have size. It gives you the right talent attraction if you have size. It gives you risk diversification if you have size. So frankly, having size is not a debate at all. The question is if we can achieve size in an environment where there is trust, you will build value. Otherwise, you will end up breaking value. So for example, if you decide to merge 2 banks, 1 + 1 equal to 2 is not good enough. It has to be 1.5. And I don't mean in terms of size of people. I actually mean in terms of efficiency overall. So if you can create good backends, say for example, if you are able to put resources into a backend service and maybe move some of your processes at centralized levels and allocate a lot of resources there and only put front-end people in your branches, maybe that is consolidation. If you then consolidate 2 branches, then 2 banks, then enable cutting off some of the branches and moving those people out to a backend location, that is consolidation. So consolidation has to have basic benefits. Then only will it be a base to grow. For example, if you have 2 branches on either side of the road, it may not be consolidation.
We have about 15 minutes left for question and answers. So my request is please identify yourself. Please identify the person the question is addressed to, and be pointed. Can somebody reach out a mic there, please? Here.
My question is to Mr. Sriram. You spoke about some measures of efficiency like return on equity. What are some of the return on equity that Indian universal banks have reported? And that's one question relating to efficiency. And second, on productivity, especially of the universal banks. if you could share some stats on the productivity per person or any other measures of productivity of the universal banks, where we are today, and what's the desirable benchmark on that?
Yeah, you see, typically, as I said in my address as well, typically if you are a self-sustaining sort of a business, you should be looking at an ROE at close to about 18 to 20%, and an ROA of somewhere close to 2, about 1.7, 1.8 to 2. And that is where is the typical, if you are a self-sustaining business, it doesn't require capital from other sources. And your valuation will start to go up and probably you will make better use of your capital. At the best of times, the ROA has been about 1.2 for the larger banks such as SBI, about 1.2 or around that. And ROE has been close to about 15, 16%. Now, how do you push it up? And that is the next question is there. If you are looking at, and that is why, there has been a series of capital infusion which has supported this growth capital by way of internal accruals over the years, so that, there has not been too much stress on the capital front. Today, there is an issue on the stressed assets and the NPA, which takes down a little bit more capital than what you do. The plowback is not there. And how do you sustain ROE of those sort of high levels over a future is something which is there, which is a question which is there. Now, you will find even in this current circumstances, the decrease in ROE, of most banks when they're at the time of stress is pronounced for smaller banks who are in the same model as universal banks. I'm saying, if you see the Indian context, most of the banks have the same model. So if you see the difference, mostly going into loss or negative ROEs or, very marginal ROEs is more pronounced in terms of the smaller banks when there is an impact on the banking stress scenario. And that is where I said, and I limited my point to saying that there is a case for looking at certain sectors, like Abhizer was talking about infrastructure. Now, whether there could be a limited 5, 6 banks who look at these sectors because they have global scale, they have global skills, and probably they'll take better risks than the across the board sort of systemic problems that are there. And there is the need for consolidation, getting up that 38, 39% of total loan assets to about 65, 70% for the top 5 banks. So this is a sort of a thing. In terms of employee productivity and all, actually, it is related to, for example, how much, as he says, how much of digital inclusion has a company gone into or a bank gone into to reduce the requirement of branch network or staff is something that is for the future. We need to plan out that. I'm sure with the digitization in full bloom, there will be enough scope for business, not only business, but also risk in terms of operating processes, back office processes to be substantially curtailed by way of employee strength, which is what is being done across the globe. Even for India, actually, we are looking at a KYC, a centralized KYC, not only for the banking sector, but across the other sectors such as mutual fund or insurance, because each one does his own KYC today, and those are the costs that are ballooning up. So while AML may be a different cup of tea, but at least in the KYC sector, there's enough costs that can be brought down. So we should be looking at a lot of efficiency improvements over the next few years going forward. All of us are in that state. And I'm sure all these productivity parameters will be on the uptrend. Yes, surely, absolutely.
Hi, good afternoon, gentlemen. My question is to Mr. Abhizer. Abhizer, I'm from Datamatics, and I'm really excited to hear about the concept of consolidation and also emphasizing on digitization and analysis, which will make banks more owning of customers as such. Today's most of the banks, when you talk on technology and digitization, they say yes, we are technologically moving on to transformations and we have digitization in place. But the fact remains, we see today there are cases where you open up a saving account right from 5 minutes to 5 days. you have loans being dispersed anything between 10 seconds to 10 days. And the question remains, when the technology is in place, we are talking about consolidation and all these things happening. Still, there's a lot of disparity in terms of the time taken into the process. Now, one of the things we think of is that things should be, the time should be reduced, but at the same point of time, we have to ensure that the quality is not compromised. We have the same level of KYC norms or other parameters of validating the information has been looked into. So in this scenario, what would be your take? That how would you like to, what would be your piece of advice for the banks per se today, that in spite of they being digitized, how they could cover up the gap which we see in most of the banks in terms of time taken to be on a same scale or be more efficient?
So you're talking about technology adoption. How
Absolutely.
best can banks adopt technology?
My question is, technology do exist, digitization do exist, but still with this digitization and technological advancement also, there are a lot of gaps still you see, and which is huge. So how this could be reduced and optimized?
So whatever we've seen, again, a lot of it, we've done a couple of transformations. Whatever we've seen is that a lot of it has to be driven from the top as a culture. So the minute the bank's top management decides that this is our future, this is how we need to get it done, I think things move much faster, as against an imposition of a process where somebody is asked to do something. So, you know, we've actually had questions with a few branch managers when we spoke, when we were, for example, digitizing a particular branch. And one of the questions you ask them that, do you really use your ATM enough? And you will find, you'll be surprised how many people actually go to a bank counter. The bank branch managers themselves go to a counter to withdraw money. There are many. So first of all, adoption, like everything else, has to be self-imposed. Charity begins at home. So do it yourself first. I think, so one is the way to do it yourself is actually the bank's top management giving that direction. And that is extremely important. Increasingly, we are seeing top managements of banks actually saying that we want to drive digitization. We want to drive analytics. And when they drive it, I think the organization follows. It's like any other culture issue.
Thank you.
I think one last question from there, yeah. Okay, both of them. Lady should not be devoid of or deprived of the opportunity.
Question from Mr. Sriram. Sir, at what point do you see like banks are cracking down on the NPA cycle? Now, as far as funding the next level of growth which may come through the government spending in railways, infrastructure, etc., are banks currently equipped to fund that level of growth, or is there a gap in that?
To my mind, the two cannot be, although in some way they are linked, but I guess they go hand in hand in the sense that you can't cut off credit. The bank survives on credit, and there is no way. And there are always opportunities for us to lend as we go forward. Even in this scenario in this year, if you see more or less, there has been a substantial growth in about 12 to 13% is what as the growth has happened. So going forward, the intent is, of course, to try and make sure that we learn from what we have learned from the past. Learnings are, and then try and make sure that we, use that for lending in the future. Opportunities don't keep coming for us to become healthy, good, and at one point to try and say that now I am sure and ready for lending. It doesn't wait. This is a dynamic process. We continuously evaluate our risk management processes. We make sure the skill levels are upgraded off and on. We make sure that opportunities are tapped by way of lending at the appropriate level. Today he was talking about digital, Abhizar, and there is a new way in which we have now started lending to e-commerce companies or other vendors who are providing to e-commerce companies in a significant way so that we are able to capture their cash flows. So in some way, the mechanism has gone from security-based lending to cash flow-related lending, which we feel is much better because we can see it on the system. And so these things will keep happening. And I'm sure we'll, as I said, the lending will go hand in hand with whatever resolution that we take for NPS.
One last question from the lady, please.
Thank you, sir. My question is to Mr. Abhizar. He spoke about digital and analytics. There is a lot of buzz regarding this big data and analytics. My question is, how ready are we for handling big data challenges?
Frankly, there is a lot of big data and there's a lot of bad data either. So how do we convert rather bad data into good data is our biggest challenge. So, in the system there is a lot of data available. Like everything else, I can give you 100 stacks of files to read and you will make nothing out of it. I can give you one piece of paper with all the information you need, and that is possibly better than those 100 files. So I think we are equipped in the sense that banks now know what they want. So interestingly, I was having a discussion with one bank, who analyzes projects, say a power, any other infrastructure project, say power project. And that bank actually sat back and said that I still go to all publicly available data through various publicly available databases to figure out how a company performs. Why can't I actually look back into my own